If you bought a property in the wrong area in 2021 or 2022 with a small deposit, you may be approaching your remortgage this year unable to switch lenders. That is not a theoretical risk. It is a documented mechanism called mortgage imprisonment, and it is happening to thousands of owners in 5 specific UK markets right now. The national average house price is up, but London is down 1.2% annually. The Southeast commuter belt has markets down nearly 9%. The national average is hiding all 5 of these markets inside a number that describes nowhere accurately. Westminster is down 27% from its peak. Not 27% from last year. 27% from the highest price ever recorded in that market. That is not a correction, that is a structural collapse. Kensington and Chelsea is down 20%. The City of London down 18%. London overall recorded a 1.2% annual price fall in the 12 months to December 2025. It is the only major region in England where average prices declined on the year. Every other region was flat or rising. London was falling. This did not happen randomly. There is a specific named cause. According to data from Henley & Partners, whose methodology is contested by some analysts, a net 10,800 millionaires left the UK in 2024. The 2025 figure from the same source is 16,500. These are the buyers who sustained prime central London values for decades. International buyers who paid in a currency that has since appreciated against sterling. Ultra-high net worth individuals who treated prime London property as a wealth store. They are gone, and no equivalent buyer base has replaced them. The Bank of England held rates at 3.75% today. The Middle East conflict is creating fresh inflationary pressure that could slow further rate cuts. Without the rate trajectory that everyone was pricing in at the start of the year, the catalyst for prime London recovery has weakened further. Rick's surveyor sentiment for the near term fell to -18 in February, the weakest reading since the market was pricing in post-budget shock. Area 1, prime central London, falling, and the structural reason it is falling has not resolved. Crawley was the worst performing town in the entire UK in 2025. Average values down 8.9% in a single year. That is, £36,300 wiped from the average property. High Wycombe down 7.4%. Brighton down 4.8%. These are not obscure towns. These are commuter towns that hundreds of thousands of buyers flooded into between 2020 and 2022 on a single assumption that remote working had permanently changed where people needed to live. Prices went parabolic. Then, working patterns normalized. The premium these towns commanded was always based on a temporary behavioral change rather than a permanent economic shift. It started deflating the moment employers began calling people back to the office. It has not stopped deflating. The crucial point is that this correction is not complete. The properties bought at peak pandemic prices in 2021 have not yet found their floor. Zoopla's February 2026 data shows 16% more homes for sale in some southeast areas than a year ago. More supply, weakening demand, sellers who bought at peak competing against every new listing that arrives. The buyers with most exposure are the first-time buyers who purchased with 5 or 10% deposits in 2021, expecting the post-pandemic premium to hold. Area 2, the Southeast commuter belt, still correcting, and the supply pressure is not easing. 38% of new build flats across England and Wales sold for a loss in 2025. Not a niche product in a struggling postcode. 38% of every new build flat transaction across the entire country. In the Northeast, that figure rose to nearly 2/3. This is not a regional anomaly. It is a property-type problem affecting hundreds of thousands of owners across every London borough and in many regional cities too. The average London flat is down 7% since the start of 2023. Almost 1 in 5 second-hand flats sold below the original purchase price in 2025. 3 forces are compressing flat values simultaneously. None of them are resolving quickly. Service charges have risen 41% on average between 2019 and 2024. The average leaseholder is now paying £3,634 annually just in service charges. That cost directly reduces what buyers will pay because buyers are calculating the total cost of ownership, not just the mortgage. Cladding liability remains unresolved for thousands of buildings. Under the new home energy model introduced in 2026, properties previously certified at EPC Band C are being reclassified as D. That reclassification adds upgrade cost and introduces lender caution on properties that were considered standard just months ago. Three forces: service charges rising, cladding unresolved, EPC downgrading, all three working against the same asset simultaneously. For any buyer who purchased a leasehold flat in 2021 with a 10 or 15% deposit, that is the definition of a value trap. Area 3. London leasehold flats. A property type problem, not a postcode problem, and it is not specific to London. Subscribe if this analysis is useful. Every week on this channel, we map the data that the national headlines obscure. It costs nothing to stay informed. East Anglia is the only English region to record an official annual house price decline in Nationwide's fourth quarter 2025 data. Not the worst performer. The only region in England with an official annual decline. Every other region was flat or positive. Available homes for sale in some parts of the region are up 16% year on year, supply rising at exactly the moment demand is weakening. This is the most counterintuitive entry on this list, because it includes Cambridge, one of the most globally significant technology and biotech clusters anywhere in Europe. The average property in Cambridge costs approximately £470,000. The price-to-income ratio in Cambridge is above 10 times. The talented graduates, researchers, and professionals that the city's economy depends on are making rational decisions to live further away or in other cities entirely. When the buyers your market depends on cannot afford to participate in it, prices drift. And in East Anglia, they are now drifting downward. The negative equity exposure here is concentrated among buyers who purchased Cambridge and Norwich properties in 2021 to 2022 on high loan-to-value mortgages, expecting the pandemic flight to quality to continue driving prices. Instead, the supply surge has put them in a market where their asking price is competing against 16% more properties than a year ago. Area 4. East Anglia, an affordability ceiling that is genuinely structural and supply that is still rising. New build properties carry a developer premium of 10 to 15% above comparable resale values at the point of purchase. The moment you complete on a new build flat, comparable second-hand stock is available at 10 to 15% less. That is not a market inefficiency. That is the developer's margin built into the price you paid. A buyer who purchased a new build flat for £250,000 in 2022 is now competing against resale flats in the same development. Those comparable properties are selling for £200,000 to £210,000. The premium is gone. The mortgage is still sized to the original purchase price. In a rising market, that premium can be absorbed quickly. In a flat or falling market, it becomes a structural negative equity position from day one. Across England and Wales in 2025, 38% of new build flat transactions completed at a loss. That is the statistical consequence of a decade of developers selling premium price stock to investors and owner-occupiers in a market that could not sustain those premiums once rates rose and demand softened. This is not exceptional cases or difficult postcodes. It is the systematic outcome of how new build flats are priced and sold in the UK. Area 5. New build apartments nationally. A structural negative equity position from day one in a flat or falling market. Now, let us talk about what this actually means for the people who own property in one of these 5 areas. The buyers with greatest exposure across all 5 markets share 3 characteristics. They purchased between January 2021 and December 2022. They purchased with deposits of 10% or less. And they are approaching a mortgage deal expiry in 2026. The average SVR is currently 7.15%. A competitive 4.5% fix on a £200,000 mortgage saves £270 a month compared to rolling onto the standard variable rate. That is £3,240 a year for every year they cannot remortgage. because their property is worth less than they paid and lenders will not accept the application on standard terms. The remortgage problem is the mechanism that turns a paper loss into a real financial crisis. A mortgage prisoner is not just someone who lost money on paper. It is someone who cannot access competitive mortgage deals because their loan-to-value has deteriorated past the point where lenders will lend on standard terms. They are trapped, paying the highest rate available, watching their equity position remain static or deteriorate further. If you bought before 2021 and have built meaningful equity in any of these markets, these are uncomfortable but manageable conditions. You have a buffer. Your decision is about timing. Get a current valuation before you decide whether to sell now or wait for stabilization, but you have options. If you bought in 2021 or 2022 with a small deposit in any of these 5 areas, the first action is to get a formal RICS valuation now, not a Zoopla estimate, not what you think it is worth. A surveyor who knows the specific postcode and the recent comparable sales. That number tells you your actual loan-to-value, which tells you your remortgage options, which tells you what your real financial position actually is. If you are approaching remortgage and you suspect your loan-to-value has deteriorated, tell your mortgage broker before your current deal expires. Specialist products exist for borrowers with limited equity that most people in this situation do not know about because they have never needed them before. The time to explore those options is before you need them urgently, not when the SVR clock is already running. And if you are an investor considering buying in any of these 5 areas, softening markets do create opportunity, but only if your entry price reflects the current trajectory, not the peak. A 10% discount on a property that is still falling is not a deal. The 5 structural reasons named in this video are not resolving in 2026. Price accordingly. The national average will keep these 5 stories hidden for as long as the North keeps outperforming. But for the people living inside these specific markets, the national average is irrelevant. The data in this video is their reality.